All right. I've got 1203 Maya, so I'm going to kick this off. Welcome, everyone. My name is Todd Headley. I'm one of the 6 partners of Lunch Pail Ventures, and I am happy you are here to participate in our seminar series. Our initial kickoff here is about commercial financing for small and emerging companies. I am pleased to present Mark Moore. Not only is he a personal friend, he is a 1985 graduate in finance from Virginia Tech, and he currently serves on the Virginia Tech Finance Department Advisory Board. Mark is a senior financial advisor with deep experience across commercial banking, investment banking, and strategic consulting. He has spent his career helping growth-focused companies navigate complex transactions from M&A and capital raises to bank relationship restructurings. Mark has held executive financial leadership roles, including Chief Lending Officer at John Marshall Bank, President at Access National Bank, Regional President at Atlantic Union Bank, and Division Executive at Sandy Spring Bank. Mark is duly qualified to presenting these slides to talk to you about commercial financing for small and emerging companies. So with that, Mark, I will let you take control.
All right. Thanks, Todd. That's very nice, considering I just still feel like I'm a palooka from Pittsburgh that was lucky to land at Virginia Tech, and then everything went from there north. So I appreciate the intro. I'm happy to be here. I'm happy to support Lunch Pail Ventures. It's a terrific organization. Been happy to be associated with it as a member for a couple of years now. Had a chance to make a couple investments, and really enjoy the whole process. So I think what you guys are doing, building out the resource library this year, and this being part of it, is terrific. I think Todd and the gang asked me, because I'm one of these bankers that's admittedly spent more time in the market than others might like to admit. And I've been around the block, and I've seen a few things, and the classic, seen the good, the bad, and the ugly of small business financing. So I'm going to try in this compressed period of time to just share some high-level insights, some high themes, maybe a nugget or two that you can take away as we run through these different financing options. We put together a deck that kind of speaks for itself, so we can motor through it in this limited time we have today. And we'll flag some pros and cons of the different types of sourcing, financial sourcing places that you can go to, and hopefully give you some new food for thought. So let's just jump right on in here. When people think about financing a business, the first thought that comes to mind is usually, you're going to go to a bank and figure something out. And while the bank is an important piece of the puzzle, and it's one that almost every small business is involved with, there's a full menu of options. And that's really what the spirit of this presentation is about. We want to make sure everybody's thinking about all the different places that you should look for financing your small business, your emerging enterprise. It changes as the company and the circumstance changes. So with respect to the very beginning, the most common source of the early stage funding, of course, is the infamous friends and family. And this is when you're still trying to get the positive cash flow. You have an idea, but you're far away from, a standalone business model. So,
Hey, Mark,
yes,
real
sir.
Quick, let me interrupt. The slide has not advanced.
Oh,
I don't
apologies.
There you go.
There we go.
Now we're on the same page.
Here we go. All right. Very good. So the friends and family, this is usually somebody that you're going to want to have a positive relationship from the beginning, because they want you to succeed and they believe in you, but also they really just want you to work this out and get their money back. Okay. And just not have an issue between friend and family members. That's really the primary motivation in their mind, but you're approaching them, very seriously, like they are a bank. So from their perspective, they just don't want any change orders or any sad stories, really, And they also don't really want you to ask them for a second round of financing. So you have to pick these very carefully. But let me tell you, almost everybody does. And the positives are very flexible terms. You're working it out up front between the two parties, and it's very low cost and low documentation, and you usually get a good deal on the interest rate and stuff and terms. The downside is that you just got pregnant with somebody who, whether you wanted them to or not, they have an opinion. They're going to share it with you. They're going to check in on you. You're going to feel obligated to check in on them. It's limited amount of funding, and this can only go on for so long. So I'm not trying to encourage it, and I'm not trying to discourage it, but it is what it is. Okay, so perhaps you start out with the friends and family, but inevitably that's going to run dry, and you're going to need to go on your own here and grind it out next level. So that's usually where you go down to the bank or to a lender, but you're also bringing your own personal resources with you. You're going to add it to your business case, and you are going to persuade them to make you a cash flow basis loan, but you're going to have a lot of backstop for it, because the banks and the lenders, whether they're banks or quasi banks, they're always looking for their sources of repayment. And at this stage of the game, you don't really have strong sources of repayment. Maybe your business model sources of repayment make sense and are believable, but there's no backstop. There's no secondary source of repayment to assuage the concerns of the bankers if your plan doesn't work out and now they're stuck and they need to foreclose and get their money back, kind of a thing. So let's say you're talking to a small business lender, maybe at a community bank at this point. They believe in you and all that stuff, but they got to convince other people to sign off on the loan. So they're looking hard at the secondary source of repayment, and that is essentially you and what you have to bring to the table, or who you brought with you to the bank agreements in the first place because they've pledged collateral or they have strong guarantees. So typically these involve things like life insurance assignments. It's very common. It's your policy. There's no upside for the bank, like they can get a windfall. If you were to pass and they had an assigned life insurance, you pay off the debt that is owed, and anything that's left in the ceiling amount of that policy, you and your other beneficiaries get. And you pretty much need to count on life insurance in the small business world for the first few years, first few $1 million of your business, in my opinion. Another very common thing is they look to see if you have equity in your residence, and they like to take a second deed of trust on that. Maybe marketable securities or pledges of cash value of life insurance, things like that. And those can be brought in from yet another person in your world, somebody that has consideration in your deal that would post that stuff on your behalf. So, and that can be a personal guarantee. And this is also where a lot of small banks are looking at SBA loans, like the 7A loan or some of the guaranteed lines of credit. So this is really the most common area. And, the stronger your business case is, the less reliance you have to use on your outside collateral and your personal net worth. But everything's case by case. So if you can back your loan with the assets and the guarantees, the banks are willing to listen. And then once you get started with them, maybe it's a little more cumbersome than you wanted. Then with just a little bit of performance, like the first year typically, that's when you start staging and positioning to get this collateral released and get it wound down to maybe just your personal guarantee. And eventually you don't even want to provide that in business and banking. So if they feel good about you as a manager and your business makes sense, you should be able to find a good way to get what you need in this area. Okay, Todd, how are we doing on pace?
We're doing great.
All right. By the way, if anybody has any questions along the way, Todd's going to monitor the chat, and we're going to try to save some 10 minutes at the end here. So you can interject, or you can save until the end and come back to anything. All right. So on the senior bet side, that's where the custom building goes, and this is where things are kind of like case by case.
Mark, you need to advance the slide.
Oh, I'm sorry, Todd.
That's all right.
As you guys could probably figure out by now, I'm not a big presenter on the technical side. All right. So a lot of time, this is where you're working with, levels of personal loan authority and levels of different comfort and so forth. And so it's all situational, and they're going to be looking at things like liquidity and leverage and your profitability, your capital base, the revenue trends, your forecasts and your pipelines. They're going to get into the weeds with you, your backlog and your payment streams. The more you can comfort them on your primary source of repayment and your cash flow, and that you do have backstops, that you can go to if you get in a jam, the more you'll be able to get this based just on business assets. Banks will take a priority secured first position lien almost every time, and the rest of the financing world's got to work around them if they're in the picture. So this is where things like the structure of the loan and the amount of collateral and the covenants that go into it, that's where everything is sort of case by case. And the stronger you are, the better terms you get. We can come back and talk a little bit more about banking at the end if you'd like. So banks are great, but they're not always fast and flexible. And this is where specialty financing areas kind of come in. These folks in the specialty financing area, they're very comfortable with either the collateral that is at issue or the industry vertical that your business is in, or the types of scenarios. And so they take more chances, and they are looking hard at the actual value of the underlying asset that they're financing. So if you are needing aggressive financing on accounts receivables, and you have a few invoices, they're big numbers, but you don't have much, and it's lumpy coming in, you might want to be working with a finance company or a factoring company that'll basically either lend against that invoice at 85, 90%, maybe 95, depending on the other strengths of the deal. And they keep the delta, but you get your cash right away, and you needed that cash not only for payroll, but maybe to take advantage of some other market opportunity.
Mark, I think you need to advance the slide again. Sorry.
So it's the same thing with leasing. They might be very knowledgeable about particular type of equipment, maybe in the medical world or in healthcare or in transportation and logistics or communications or IT. And they will take a look at the residual value of these things, and they'll assume you go bankrupt and they're stuck with these used assets. What can they get out in the market? So these specialty lenders, they're looking at the hard asset much more seriously and putting more value on it than the banks and family and friend or personal collateral and guarantor dependent stuff is going to be.
And I think your next slide is the pros and cons.
So yeah, here are your pros and cons. So you get fast access. They're much faster than banks. These deals can get turned around really in a week, 10 days. I know Todd's had them turned around faster than that. But they also can take time to document and get the collateral perfected and all that too. I want to make sure real quickly here, there's a few terms that come in this part of the world, that the finance world, carve-outs. I think you all probably know that, but just to make sure, that's when one lender will agree to carve out an isolated asset within the balance sheet and let another lender lend against that. But that other lender doesn't have any claim to anything else other than that one asset. That's a carve-out. This is important because as your business gets more complex, you're going to need to be able to work with multiple creditors from time to time, where they might have an interest in common collateral, but one's going to have the priority interest in it, and the other one's going to have it'll be nice to have a second lien. It'll help interest in it. So that's where these folks are much more interested in the equipment, the source of repayment, the terms of the invoice. Less concerned about year-long cash flows and what your 3-year plan looks like. Perception issues. When people talk about perception issues, it used to be that if you went to anything other than a bank, you kind of got a black mark, whether people said it or not, because they figured you weren't financially strong enough to go to a bank. So you had to work it out with a non-bank. That's not true anymore. In fact, even if that was your circumstance, you don't have to concede that anymore, because with treasury management and all of these competitive fintechs out there and the technology that's in the market, people are getting money from all over the place these days. And so if you do use family and friends or a leasing company or a factoring company, don't let the world around you convince you that that's a sign of weakness. That's just the financial resource you chose to use for that particular circumstance. So hold your head up when you're using non-banks and be aware of perception issues. And then I mentioned the intercreditor agreement. So let's say that I'm the banker for Todd's company, but he has this $2 million MRI machine that he wants to finance. Well, that's a little bit too much for me and my bank, but we like the plan. We just want somebody else to do it. So we would carve out our security interest to allow the leasing company to have a perfected lien on that MRI equipment and everything associated with it. And they would do their deal with Todd's company, and I'm merrily going along with everything else as the banker. That's very commonly done, and those involve intercreditor agreements. So everybody's got to be believing in the same outcome in that scenario. I'll keep moving here. So spot financing, spot funding. All right, we use an example of here. You may have an inventory ramp up need. Here, let me catch up to my notes here just for a second. So these are essentially niche lenders, and they're very comfortable with some combination of their subject matter expertise in your collateral or the industry that you're in or the profile of you as a borrower. And so they will basically combine their comfort in what you're doing on a particular transaction that needs short-term financing, like 30 days kind of a thing, or maybe 10 days. Combined with the fact they use predictable statistic analysis a little bit here too, and they come up with terms that, you know, most people pay back on these terms, and the ones that don't, we make enough from the other. That dynamic becomes even more prevalent when we get into merchant financing. So there are lenders that will just step up, put down quick money quick because they believe your story, and you can use those, but you don't want to get used to it too much because you're scrambling all the time. It's always short fuse, distracts from the normal flow of business. I don't really recommend it as something to build a business model around, but you know, you got to make decisions every day, every hour on what's the best thing to do. And sometimes spot funding sources can come through.
Mark, what happens if it's got a short fuse and you fail to repay? Something hiccups, and instead of a 30-day repayment, you're looking at, say, 60 or 90, but you're confident it's 60 or 90. What happens to this relationship, and how do you keep it intact to get to that 60 or 90-day point?
Well, the reality is that the people that play in this particular league, they've been around the block. They've been in some recoveries, some workouts, some liquidations, turnarounds. They've exercised all their rights and remedies under these loan agreements, you know, legally. So this is a smart group of people, and it's all very contractual. So to answer your question, if you borrow money on these terms and something bad goes on and your plan isn't going to work out after all, and what you thought was going to pay the lender back isn't there, you know, you're going to have to really, you're at their mercy at that point. Otherwise, they'll try to get all they can out of you quick because they think you're a melting ice cube. So you have to communicate well. You have to be honest. You have to point them to the solution that shows them the way home if something took a side turn on you, or you got to come up with another plan or you got to pay them off. If you don't, they're going to wreak havoc on your credit with vendors and suppliers, and they're going to just legal up and distract you from running your business. So
two guys that look like they were on The Sopranos might be showing up at my door.
they
telling
might
me-
be if
Telling
you
me I
can't,
got to find my wallet.
you got, so, you know, but there's also businesses with some history that do this kind of funding too. So this is similar to when we get down here. Let's just jump to this real quick rather than have it be an afterthought. This is the extreme version of what we were just talking about in here. And there's all kinds of merchant advance. You know, I see them on TV all the time. That stuff scares me. I mean, you're looking at extremely high interest rates, fees. It just seems too good to be true. But this is where I believe it's like the credit card industry. The statistical probability is driving their decision making. They really don't care too much about your business model or you. So these are areas where they're available. There's lots of them, but you better be careful who you're working with, and you really don't want to rely on this kind of rapid financing too much, I don't think, if at all. Now, you get fintech guys in here, give a presentation, they're going to say a totally different thing, and you should listen to them because there's, you know, it's not the world I live in. So, all right. The mezzanine sub debt, you know, so this is a little bit farther down the road for you guys. This is when your business has been stable and you've been having healthy relationships with banks, because that's the lowest cost of capital, is always with the banks. That's why everybody plays the bank game so much, because in the end, that's the cheapest money every time. So the sub debt, this is for more sophisticated situations where the enterprise is a little bit farther along. There's some predictability of cash flows, revenue streams, and you are going to enter into an agreement that's basically going to induce these guys to lend you some aggressive long-term money for some equity upside, whether it be in the form of options or warrants or synthetic equity. This is Todd Headley's world very much. And we could spend a nice seminar just talking about sub and mezz debt things. But the pros are, this is, again, it's more seasoned businesses, but there's flexible structure. There's a huge market out there. People are dying to lend this kind of money for good situations. So there's definitely availability for good plans. This kind of money usually fills the gaps around like your line of credits that you might have, or your mortgage on the building that you have. But you want to hire a bunch of people, or you want to make a small acquisition, or you need to buy some new equipment. You want to move into another market and you need to spend some money to set yourself up there. Those are often kind of purposes where this sort of money is used, and you're pulling in a financial partner that you most times envision being with you for the duration, and that you might be able to go back to them and borrow more for more things. So, Todd, I don't know if you wanted to add anything on mezz, or even Peg at this point, with your experiences. Is there anything you might add?
I think you've covered it. Obviously, when you get to this point, your business is more mature. There's a heavy look at your financial performance, your balance sheet, who the executives are of the business, what market you play in, your strength within that market. All of those elements come together. I think the takeaway point that you mentioned is you're looking for a longer term relationship here. I think some of the other financing mechanisms you talked about earlier are opportunistic, potentially even one time, and you're seeking out a marriage partner for that specific element. Here, this is more relationship oriented. And once you get in and prove that the business is very viable and you're executing in line with your operating plan, more financing tends to become available based on the strength of that relationship.
That's very well said. Just to echo that with what Todd was saying, what I see for most businesses, and where I believe you guys want to get to or you want your clients or your investment companies to get to, is you want to be working with a good bank, but a good banker within that bank, and get yourself a little banking team at that place that helps you aggressively borrow all that you prudently can, but also you got to get the credit people to support those activities. So you want to begin to establish a relationship with those that make the loan approval decisions too. And the treasury management side of the house, you can make as much money on managing your cash and not borrowing because you're managing your cash as you can about fighting about interest rates and fees. So treasury management and cash management combined with an understanding of how your loans are getting approved and the decision-making process and the players involved, and then just honest relationship. Just, it doesn't always have to be the best of news. Just tell your banker what's going on, because as an industry, we tend to be nervous Nellies, and we're surrounded by nervous Nellies on the credit side and in senior management. We're always convincing somebody about the virtues of this up and coming company and owner that we want to really kind of do some special things for. So don't burn the bridge by telling fibs, and don't make the mistake of withholding bad news for too long, because you don't want a panicky banker who feels like he or she's about to have a problem loan on their hands.
So Mark, you've lived in this world on the other side at the actual bank, and I know you've been a good advocate for your clients. It's almost like you're negotiating internally on your client's behalf, especially if there's news that's a little sideways or bad. You're putting the appropriate context on it because your company, if it was me in this case, was honest with you. So I armed you with all the tools to calm the nervous Nellies internally.
That's right. And also the smart borrower and the smart banker together, they work together one-on-one to put together, a realistic revised story, because clearly at this point something's gone sideways or not according to plan. But it always comes back to the same things we talked about earlier: a positive cash flow and the strength of your repayment sources to make that positive cash flow continue. The primary source of repayment, you solve all that, but then you comfort them on the secondary source of repayment where you're conceding. Let's just say an asteroid hits the business, everything's blown up. How does the bank get home? That's when they're looking at those secondary sources of repayment: guarantees, hard outside collateral, SBA guarantees, etc. So just put yourself in your lender's shoes and think about how you would calm that lender down and actually get them excited about doing what you want them to do next, which might be modifying the deal you already have or lending them more money. Even in a difficult situation, they might need it, and you'll have to, get them there mentally. But it happens every day. And also, to tell you the truth, usually there's somebody at every bank that has at least $1 million worth of loan authority that you can sit down in front of and have a conversation with. It may not be your banker if you're a small business at a small business bank, but her boss or her boss's boss has a rational, reasonable head. And if you just get in front of them and tell them what's going on and how everything's going to be okay, and you appreciate their patience, but you need them to go along with this or that, that'll get you so far into your small business financing needs. You should be okay.
Are you ready for Q&A?
Yes, sir.
Excellent. Let me throw something out there. And again, you've been on the opposite side of the fence from me. I appreciate that you're over there. And I understand the perspective that you have. What is your feeling when a client is looking at multiple sources, including multiple sources that look like you? So I'm dealing with you, and I'm dealing with, John Smith down the street who works for a competitor bank. and I'm literally asking for the same type of loan. How do you view that process? And the second part of that is, what is your recommendation to guys like me and those on the phone for seeking multiple sources?
So I think you're saying you're going to cheat on me, and how am I going to feel about that?
Well, the question is, do you view that as outright cheating? If we don't have an existing relationship,
Right.
I'm trying to get into this
Okay, you're not my client.
financing
You're
arena.
my prospect.
Yeah, so I'm a prospect. We
Okay.
haven't gotten married yet, but if I'm prospecting, it's pretty commonplace, right, that I'm also looking at other banks that look like you.
This is true. So what we think is that you are talking to 5 banks, even if you've only told us about us and somebody else. You know that because if you're in any kind of a bid process, the implication is you got something good, and people are going to have to hup too if they want to win it. So the process is good because it causes everybody to really sharpen their pencils and to think like they need to make their first offer work because they may not get a second chance. So I think it's healthy to allow bankers to know that, you've got a short list and they're definitely on it, and you want to see it work out. Crazy market right now.
I've always told bankers, hey, it's a level playing field. I'd love to do business with you, but as the CFO, I would be derelict in my duties if I tried to sole source this before we have a pre-existing relationship.
I would respect that. I think any good banker respects that. That is what you're supposed to do. And that's, we want our companies to do best practices. And what you just described is a best practice. So yeah, that part's good. Now, I was teasing a little bit. Let's pretend you are my client.
Well, that's what I wanted to get to next. So
right.
I am your client, and you find out that I've gone down the street looking for a loan that you would have been willing and able to do.
Okay, so if you went down the street for a loan that you also felt I would have been willing, able, and presumably would have liked to do, you must have some reason to want to check another place with the banker or the bank or the process or something, or you just want to do a gut check to confirm your expectation that your own bank and banker are giving you solid terms and they're not taking advantage of the relationship. So, but it does introduce a little bit of insecurity into the banker, which could be good, but it can also, I'd say it's better for you as the company to keep your banker reminded it's a very competitive market and your phone's ringing off the hook. But if you have a good banking relationship and you're happy, that means you're not spending a lot of time worrying about your bank financing or your banking arrangements, and you're able to concentrate on your business and everything else. So I honestly, even if I wasn't a banker, I would say if you have a good banking relationship and you get what you want and they treat you well and you're satisfied on pricing, I'd enjoy it. I wouldn't mess around with it.
Amen. Yeah, I would tell people focus on, keep the strength of that relationship. Around the edges, you can spot check to make sure the terms and conditions, collateral, everything is market and that you're being treated fairly. In the one situation where I needed to go down the street, I talked to my pre-existing relationship and said, hey, my hands are tied, which is true. The board has asked me to do X. I'm telling you, because we have a great relationship, but if you can do this, put your best term sheet in front of me so that I can go to my board and say, I told you we had a great relationship, and look at what these guys did. They stepped right up and got everything. So we really don't need to go down the street, create a whole nother relationship,
right,
and then create the tension in the existing relationship.
I totally agree to that. And also, I think whatever you're in your banking relationship, or whoever your lender might be, if it's not a banker, but let's just say it's banker. When you have a new need, you give them a good package, a thoughtful package that's well organized, financial package. you give them a reasonable period of time, like 3 days, 5 days, 1 week, and you tell your banker, listen, this one might be a tester for us, but this is what I need. And I'm pretty sure it's available. I hope you guys like it. You know, then what you just said, Todd, give them a chance, but don't give them 2 weeks to just do a meandering maybe on you without you having started a process somewhere else. So you really kind of sort of got to feel your banker out at the very beginning of a new loan scenario, engage their enthusiasm. If they're hesitant at all, it kind of gives you a free license without guilt to check elsewhere, because you got a business to run. And sometimes bankers just chicken out for bad reasons. I hate
Agreed. The credit
Hey.
people might be leaning on them too hard, saying we can't get out over our skis on this one, even though it's a pre-existing client.
Yeah. So this might be time for one of my last little nuggets, and it is beware of the meandering maybe. Okay. We always say a quick no is better than a meandering maybe. The meandering maybes in banks can go on for weeks and weeks and weeks. Don't ever let that happen. There's no need for something to drag out for weeks and weeks. I can see why it takes 1 week, because senior exec so-and-so has got to catch her at the right time when she's in the right mindset. I mean, there's a lot of that stuff that goes on. Or, you know, your boss is traveling and he won't be back until Tuesday. But that's it. You can't let these guys take over your lives and your projects. It's the world's not like that anymore. It's not like Mr. Drysdale and everything takes 2 months and we'll let you know what we think.
Sounds good. Hey, Maya, can we open up the mic so we can take questions from the audience? Because I see some mics muted. I don't know if I can unmute them. I can't. Maya, are you there?
Maya is in class.
Everyone can unmute themselves, is what she said. So
Yeah.
if you have a question, she's in class. There, our super intern, hard at work.
Yeah,
Lunch Pail Venture stuff from a classroom at Virginia Tech. Thank you, Maya.
Hey, Todd, Mark, can you all hear me?
We
Hi,
can.
Peter. Yes.
Peter.
Nice to meet you guys. I'm a fellow Hokie, class of '89,
All right.
marketing, Pamphlet School of Business, playing the golf team at Tech. Nice to meet you guys. So, listen to the presentation. Mark, fantastic presentation.
Oh, thank you.
I'm a regional executive with John Marshall Bank, been in banking since 1989. I loved everything you said, took some notes even. I love how you position things. One thing I'll just add to the conversation, because to the last part, what the last golden nugget that Mark talked about, which I completely agree with, but there's also a cadence to working with your banker. What I mean by that is that we're working on a dozen deals or so at any given time. And when a client comes to us and has a nice package, nobody comes to us and it's a perfect package. Maybe it's 50%, 80%. There's always going to be a few things that are missing. But there's a cadence to working with the clients. We really get our best results done when we need something and the client is giving us what we need in a timely way. When we have to put something down and let it rest for a couple of weeks and then pick it back up, it starts all over again, because there's a whole team of people. There's a credit analyst working on it. There's the RM. There might be another person that's helping the RM. And so there's this cadence that's going on. And it's sort of like runs counter to the meandering maybe. I agree with Mark 100%. A fast no, we want to give you a fast no because we want to waste your time, waste our time. But if there's a chance to get this deal done in a way that works for the client and makes it work for the bank, we want to fight for that, right? So just be my recommendation would be just be as prepared as you can and not fight the banker on why they want information. Just provide that as much as you can. And a really good banker will help you get there. Okay?
Yeah, be responsive.
That was terrific, Peter. Well said. I totally agree with that. Thank you.
Thank you.
Hey, Mark, I have a question on line of credit. So
Yeah.
About $750,000 is hanging around the bank.
Chris, can you repeat that? I'm sorry. One more time.
You're a little bit choppy.
A little bit jumping. I'll try to.
No, choppy on the audio. Sorry.
That's strange. Yeah. What about line of credit? So I've got about like 3/4 of a million just hanging out. Can I work with the bank to get a line of, because I don't want to freeze it up and put it in notes or anything like that. Because I
Yeah.
might need it. So
Yeah,
working with the bank for a line of credit would be something to do, and is line of credit something I should always go after?
absolutely. Do you pretty much carry that level of receivables most of the time?
Yeah, I split. Well, now it used to be Sandy Springs. Now it's going to be or whatever the new one they are.
Yeah.
But you normally have in a sweep account. I usually have between $500 to $1 million just hanging around there, and then I use Truist for payroll and day-by-day expenses.
So you're an ideal customer because you're an ideal bank client right now in this market because you're a net depositor. And the bank takes your deposits in your checking account and uses it to fund the loans that they charge their interest rates on. So you're a very valuable customer where you are. I'd be happy to talk to you offline further, but my initial reaction is if it would be handy for you to have like a $250,000 working capital line of credit where you have receivables of that level in your company's in general good health, you were to guarantee it shouldn't be a problem. And then you'd have it available. You could use it for whatever you want. It shouldn't require them to take a lien on it, like force the accounts to go through their bank, but you might be doing that anyhow for your cash management.
Yeah, Chris, during my career, I like being able to put in a working capital line of credit when I could, not necessarily when I needed it.
Yes.
What I wanted was that safety blanket. If we hit a little bump, that I could pull on that to make payroll or make a capital expenditure that was in the plans that is going to help my business down the road, rather than be tied up waiting for a big receivable to hit and my cash flow to improve. So to me, working capital had typically been, there as a rainy day. And what I try to do is negotiate the best term. I mean, you have to pay to get it in place. So as long as the cost to put it in place, even if it wasn't going to be used, was reasonable, I went ahead and did it.
I would add to that also, it establishes a borrowing relationship with that bank. And if you went a year and you didn't use the line, that's positive from their standpoint. It would also be positive if you used it, paid it back, used it, paid it back. The thing that they don't like is when a borrower draws the whole thing out and it never moves, and then it's permanently out, and then the banker's like, well, damn it, that was a short-term facility. This has become permanent working capital. So then they got to like restructure it.
You got to renegotiate and restructure. Exactly. I've had one of those.
No, I encourage it. I bet Peter would agree.
I agree 100%.
Lines of credit, they're like umbrellas.
I would also add to that, get a HELOC. Same thing with a HELOC. Put a HELOC on your house as a backup. It's like having an umbrella. Have an umbrella before it rains, right?
Exactly. And Peter's mention of HELOC is a good idea, folks. You could use a home equity line of credit yourself and take care of, the friends and family stuff, the torturous process at the bank in the early days to collateralize a business loan. If you had what you needed in the equity in your home, that's cheap money.
Yep. It's the best money you can get. Gentlemen, I got to drop. It's a pleasure, Mark. Great presentation. Nice meeting you guys. Got to get to a call. Thank you. Have a great day.
Thanks,
Bye.
Peter.
Thank you, guys.
I think we're pretty much there at
We're
the
up
end of the
against
time
time.
anyhow.
If anybody else had another question, I'm sure we have time to handle it there.
All right.
All right, Mark, I want to thank you for presenting this. The good news is this slide deck and this presentation will be available on the Lunch Pail Ventures website. This is the first in our seminar series. So thanks for being the guinea pig to kick this off. Great content, and hopefully it'll get viewed a bunch of times. And I want to thank everyone who came in and participated today.
Well, Todd, it was a pleasure. I appreciate it. I particularly enjoyed the question discussions at the end. I'm showing you my email address. If any of you all would find value in chatting with me about a particular situation you're in or a hypothetical what if, I'm always happy to talk to you about that. And I wish you all great luck. Remember, there's all these different ways to finance your business, okay? And it's okay to use things other than banks. Just be smart, use them judiciously, know what you're doing, and use advisory support around you if you're going into a new lending scenario you haven't been in before. But I hope you all do very well, and I'm sure you're going to go through all of these different steps on the ladder of financing at one point or another. Good luck. Go Hokies.